market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So the Fed has opted for an outsized interest rate cut designed to preserve the strength of the U.S. economy as risks mount to the labor market. Speaking after the meeting, the chair, Chair Powell, said the half-point cut actually reflects the central bank's risk management approach as they aim for a soft landing.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Well, joining us now for more on the markets, Tim Graf, head of EMEA macro strategy at State Street Global Markets, and our very own Mark Cudmore, our Markets Live executive editor. Mark, this is an exciting day. The Fed cutting by 50 basis points. Markets went down because Chair Powell seems to have made clear that actually he won't keep cutting this fast. I mean, what was it, like a dovish cut?
No, this was not an overly dovish cut, given the expectation that, there might be even more priced into the curve in the dot plot. In a way, it was a slightly hawkish cut, but with a slight twist. The fact that they even went 50 basis points, the fact that we got to the situation they had to yesterday once 40 basis points is priced, but the fact they got it to 40 basis points pricing just shows the extremely dovish reaction function of this Federal Reserve. It shows they don't really have a dual mandate. They absolutely prioritize the labour part of their mandate, and that they are willing to ease as soon as there's signs of cracks there. And it's that broader dovish message, that's the kind of the idea of the very dovish reaction function, even if in the short term they didn't deliver as much in the dot plots as the rates priced.
Yeah, and the dot plot, actually, Tim, is extremely key to try and understand what comes next. And it's very clear that there was a big shift in the predictions for where the rate will be at the end of the year.
Yeah. And I think really what the Fed did, kind of to Mark's point, is that they really just sort of justified market pricing. Market pricing really has rates only getting to neutral out 2 or 3 years. There's a little bit of a deviation, but it's a couple of years out. It's so small, it doesn't really matter. So I think that's why you have maybe some hawkish interpretation. Even though it was a dovish move, it was a bigger cut than was priced and was expected last week. But as Powell said in the press conference, I think if they had the July employment data, they would have probably gone in July. And so this is a little bit of a catch-up, but the pace is 25. And I think maybe the market had hoped the pace might be a little bit faster, but it's a little bit more of a gradualist approach is the message.
But, Mark, and I know the market is almost never wrong, but given what Chair Powell was explaining and given where the markets actually ended up, they would decide to retreat as this mega cut they saw as a disappointment. Are they right?
I don't think this is a disappointment. I mean, overall, while cash equity markets closed down, stock markets are clearly higher. Futures are way higher since the decision. All across the world. I mean, this is a very clear bull market. It's a bullish signal. We've seen equity markets everywhere rally. We've seen crypto markets rally. And I said, including in U.S. markets, just cash markets closed a little bit weaker. But overall, futures markets are up significantly since the decision. So this is an extremely bullish decision. And I use the word bull market. What I mean by there is in the classic old term that in a bull market, you don't worry about the kind of twists and turns of the short term. Who cares if the markets are going to be up in 24 hours from now? The point is the underlying trend is very strong. You've got good global growth. You've got good U.S. growth. Sure, it's not booming, but global growth is set to be better than last year. U.S. growth is probably set to be similar than last year. This quarter's growth in the U.S. is set to be better than last quarter. So growth is doing absolutely fine. Meanwhile, you've got central banks easing policy. Earnings are still good. Energy prices are low. Disinflationary trends are still in place. This is an incredibly bullish market and bullish environment. At some point, those factors will change, but they'll need more than one to change. So the market at the moment is taking this very, very enthusiastically, and rightly so. They will not continue gaining at this pace, though.
Tim, I mean, some could argue that actually, such a big cut was just not necessarily, because big cuts generally happen in great times of stress, the pandemic, the global financial crisis. Is there a worry that actually they underestimate the impact of inflation longer term?
I don't think so, because income growth is starting to slow. You have for whatever it's worth, productivity growth in the U.S. is relatively strong. And so the wage growth you're currently seeing, which really future inflation almost has to come from wage growth. The pandemic-era stimulus has been spent. You are going to get easier conditions now with rates easier, I suppose, and that may create some upward pressure on inflation expectations. But those expectations are really well contained. The Fed could feel very confident that that part of their dual mandate, which I disagree with Mark, I think they are paying attention to the dual mandate insofar as inflation has normalized enough, but more importantly, expectations are very contained. They can go ahead with that. And it really is labor market or labor income growth that will create future inflation. But the growth we're seeing, given productivity growth, is not inflationary at the moment. And I think that's why they felt so much more comfortable acting and acting forcefully to start.
Mark, what's your take on what happens next? And again, I know there always needs to be some observation on politics. I feel like it's unavoidable so close to the election, where also one of the candidates politicized the Fed.
Yeah, I mean, look, I think that politics is the next big risk out there. I think in many ways, the Fed as the big risk for the market has taken a back seat for the moment. The Fed's always one of the most important drivers in the market, but it's not going to derail things at the moment. I think, in going to Tim's point about inflation being under control, he's right that the disinflationary trend is very strong. And I think he makes a valid point on the lack of inflationary impulse from the productivity side. But my worry is that we give too much credence to inflation expectations when really these are the things that we've relied on in the past 40 years when we didn't have an inflation problem. When we suddenly had an inflation problem, they proved just wildly useless. They did not move or give us any indication of the scale of the inflation shock we'd then get. Now, many would say, well, that's why we managed to eventually control the inflation problem, because inflation expectations didn't get unanchored. But I'm worried that we've got too much complacency in the system around inflation and expectations. So short term, yeah, disinflationary trend is still there. I am worried that with this triggering of animal spirits, with the impulse going back into the economy, that there is a risk that inflation does rear its head again in 2025 unless we get a sudden, much more severe economic growth slowdown.
But they would have thought of that, Tim.
I think so. I mean, the Fed takes all that into account, and I would agree that particularly consumer inflation expectations really don't have much predictive power. Market-based inflation expectations, which is what I tend to rely on, their predictive power isn't great. But you kind of have to have something, I suppose, if you're trying to set policy kind of out the front windscreen as opposed to the rear view mirror. And so as long as they're stable, and I think that's the key point here, is something like five-year forward inflation expectations have been very stable around a range that was low relative to the pre-GFC norm. So that tells me things are contained. And then again, if you look at the labor market and look at wage pressures, because that's, in my view, where inflationary impulses have to come from at this point. Yes, things will ease up now. The labor market potentially, well, I think the Fed hopes, will start to heal a little bit, or start to, the weakening we've seen will maybe start to reverse. You might get some wage pressure there. I'm very open-minded to that. But so far, you don't seem to have too big of a de-anchoring risk.
OK, Tim and Mark, thank you so much. Both stay with us now. The Bank of England is likely to decide against cutting UK interest rates for a second straight meeting, maintaining a pretty patient approach to reversing the most aggressive policy tightening in decades. Well, joining us now from outside the BOE is our UK correspondent, Lizzie Burden. Lizzie, when you look at what we heard from the Fed and the gravitational pull from the Fed, I don't know whether it nudges the BOE to do anything.
Well, Francine, if you look at the bets this morning, they've barely budged post Chair Powell, so it doesn't look like things have changed. Why? Well, they'd already priced in the expectation of a half-point cut from the Fed when all the hints were dropping in the Journal and the FT. And you could look at it another way. You could think of it as Chair Powell doing a bit of the work for Andrew Bailey. And he did actually manage, it seems, as you were just discussing, to land that message about a soft landing. So it would appear that the BOE has less to fret about, perhaps. The other reason why they're likely to hold today is that services spike in inflation yesterday. That is something that the BOE has flagged as a concern. And of course, at Jackson Hole, we had this cautious tone from Andrew Bailey. So the expectation among economists remains that you're going to have a cautious hold today, with actually a less finely balanced split than last time. 7-2 is what we're looking for, with a particular eye on Alan Taylor, the new member of the Monetary Policy Committee, and an eye on quantitative tightening, the pace of asset sales. Do they ramp it up from £100 billion? Would be consequential for the new Chancellor, Rachel Reeves, at her budget on October the 30th. But again, the expectation among economists is largely that they're going to keep it on hold.
Lizzie, thank you so much. Our UK correspondent there, Lizzie Burden. Tim, when you look at what markets are expecting, I mean, they're hoping Andrew Bailey to provide some kind of hints on what happens in November. He's always pushed back against market expectations.
Yeah, but I think now, as was mentioned, the Fed kind of gives him some runway to maybe be a bit more easy. And when it comes to the Bank of England, I come back to how rate markets are priced, and particularly now how they're priced vis-a-vis the Fed. Before yesterday, markets were priced for rates in the U.S. to get to neutral. They were priced for the U.K. to stay tight for the next 3 years, which to me is crazy. That suggests that U.K. monetary policy will be tight at that point for 4 to 5 years. I don't see that happening, not with the rest of the central banking community globally, whether it's the ECB, the Fed, the S&B, whoever you want to point to. It's getting easier, and the UK being an outlier from that, I don't think it's that insulated that it will be able to resist that pressure for too long. Not this meeting, but future meetings for sure.
Mark, I mean, we did hear, of course, from Andrew Bailey at Jackson Hole again saying that, rate setters need to be very cautious because the job is not complete when it comes to inflation. He signaled that there's growing confidence, I guess, that some of the second-round inflation are smaller than expected. But is this, the market is running with another narrative. And do you think we have the data to support what they're trying to how they're interpreting what's coming out of central banks?
I'm with Tim that I think that, the pricing for the UK is too cautious. I mean, to me, it seems bizarre that, as Tim points out, we're pricing US rates to be slashed aggressively while UK rates are staying high. Now, this year has shown that we can slightly decouple in terms of the rate cutting cycles. They don't have to be obviously simultaneous. And I know UK has had some sticky issues, but the US economy is much stronger. Look, full year inflation for the US will come in higher than the UK this year. Full-year growth in the US will come in at least twice the level of the UK this year, even though it's been an improving outlook. And yet, it's the US that's cutting rates, not just by 50 basis points, but also pricing another couple of cuts before year-end. And yet, we're tentatively talking about UK cutting before year-end. Ultimately, two-year yields in the US trade below the UK. I don't think that's a sustainable situation. I think over the coming 6 months, that will unwind. I think two-year yields have upside, and UK two-year yields potentially have downside. I think it can actually work from both directions, but I do think the two-year yields are too aggressively priced, and definitely they can't both be right. The relative trade there is just completely off.
No.
Totally agree. I think that's one of my views for the next year is pay UK rates, receive US rates. Even though I think the US rates curve probably has a little bit more to even be priced in. You need to price a probability of a harder landing in the US, and I don't think that's actually in the pricing. But that doesn't matter vis-a-vis the UK, because that pricing is clearly not there for the UK. It is priced to remain tight for 3 years. And that strikes me as just off the charts crazy.
Off the charts crazy. There you go. CFA level 5.
Yeah.
Tim, thank you so much. Tim Graf, head of EMA macro strategy at State Street Global Markets. I'm Mark Cudmore, Bloomberg's Markets Live executive editor. Coming up, a new wave of exploding electronic devices in Lebanon ramp up tensions between Israel and Hezbollah. We have the latest from the region next, and this is Bloomberg. More telecom devices, including walkie-talkies, have exploded across Lebanon, with the country's health ministry putting the total death at 26. Meanwhile, Israel's military has declared a new phase in the war and says troops are to be diverted to the northern border. Now, for more, let's bring in our Horizon Middle East anchor, Jumana Bersace, and Bloomberg's Paul Wallace, who's in Tel Aviv. So, Jumana, walk us through what happened yesterday in Lebanon.
Yeah, well, this was the second day of communication devices exploding across Lebanon. Yesterday, the explosions came from walkie-talkies used by group members of Hezbollah that exploded into fire in cars, in people's homes, in shops. The Lebanese health ministry putting yesterday's casualties at 450, including 20 deaths. And of course, this comes after another wave of explosions that happened on Tuesday, triggered by pagers also going off simultaneously, that saw 2,800 people get injured, 12 people killed, including 3 children and medical workers. And of course, the country now is on a high state of alert because it is the second such incident of a severe breach of security and intelligence vis-a-vis these devices that Hezbollah group members have been using. And experts in the field say that could have only possibly happened if the devices had been uploaded with explosive material at some point in the manufacturing supply chain or in the process. We are watching out for later today a speech that the Secretary General from Hezbollah, Hassan Nasrallah, will be giving at about 5 p.m. local time. But certainly there is a feeling of deep paranoia and also a lot of fear about what happens next in the country.
Paul, what have Israeli authorities been saying and not saying about these events?
Francine, in public, they are keeping very quiet and not commenting at all about this, about these operations on Tuesday and Wednesday. Here on the ground, it's taken as a given that Israel and most likely Mossad, the external intelligence agency, was behind it. Overall, the feeling is that tactically this was very, very impressive. There are some Israelis questioning the strategic reasons behind it and whether this was something that would really deal a heavy blow to Hezbollah. Jumana mentioned all those casualties. A lot of them were injuries to people's fingers. Some people had their fingers blown off and things. But it's not the kind of operation that would deal a huge blow, you'd think, to the group's ability to fight militarily. It's thought to have more than 100,000 fighters, and a lot of its power comes from its weaponry of its arsenal of missiles and rockets and things. But whatever the case, it's a hugely embarrassing blow to Hezbollah. And Jumana mentioned the paranoia. It's whoever was behind this, it was clearly in part a way to deal a psychological blow to the group.
And Jumana, Secretary Blinken has also been in the region. What's been the U.S. response?
Yes, well, this U.S. Secretary of State, Anthony Blinken, is in the region on his 10th trip, actually. But he was in Cairo to push forward with these ceasefire discussions vis-a-vis Gaza. But, of course, he was asked about the incidents in Beirut. And it is interesting to note here that Anthony Blinken said the United States did not know about, nor was it involved in these incidents. We're still gathering the information and gathering the facts. And he went on to emphasize and reiterate that they do not want to see a further inflammation of tensions within the region and that they don't want to see the Gaza conflict spreading to other countries. And of course, you have to take into consideration that the last couple of days does actually amount to a significant escalation, especially because now you have the likes of the Israeli defense minister talking about potential redeployment up in the north. You've also had comments from the Iranian envoy to the United Nations. He sent a letter saying that Iran reserves its rights under the international law to take required measures deemed necessary to respond to such a crime and violation. Why is that letter being put forward from Iran? Because also, just a reminder, on Tuesday, the Iranian ambassador to Lebanon was also injured in that pager explosion attack. And therefore, there is a risk of this becoming a broader regional conflict.
Jumana and Paul, thank you so much for joining us. Jumana Borseche in Dubai and Paul Wallace in Tel Aviv. Much more to come, and this is Bloomberg. Well, Bloomberg has learned a large group of secured creditors of Altice France have sent the company a proposal to fix its €24 billion debt pile. Now, the plan raises the possibility of billionaire owner Patrick Drahi losing control of the embattled French telco. We understand it's unlikely to be accepted by the firm. Boeing's largest union says mediation with the plane maker concluded today without reaching a resolution to an ongoing strike. Now, it comes as Boeing moves to require some workers to take unpaid leave to preserve cash during contract talks. U.S. workers face a week of unpaid leave per month as the strike continues. Coming up, we'll be joined by Katharine Neiss, Chief European Economist at PGIM, for more on the Fed's first rate cut in 4 years and a look ahead to today's BOE decision. More on that next, and this is Bloomberg. Well, good morning and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The Fed goes big, Stoxx rally after an outsized cut in U.S. interest rates, but Chair Powell cautions on the speed of further easing.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
The BOE is next. Economists expect UK rates to stay on hold, but will the Governor Andrew Bailey hint at a reduction in November? And Israel declares a new phase in the war with regional Islamist groups as Lebanon is hit with a second wave of exploding electronic devices. Now back to our top story, and the Federal Reserve's bold start to cutting interest rates has reshaped the policy horizon for counterparts across the world. Now attention shifts today to the Bank of England, where we'll get a rate decision in a few hours. Now for more, let's bring in Katharine Neiss, Chief European Economist at PGIM Fixed Income. Katharine, as always, thank you so much for joining us, especially on what feels like a very big day. They cut by 50 basis points. Is it because they were behind the curve?
I think so. I mean, I was a bit surprised, I have to say, back in July that they didn't cut 25 basis points. If we look at inflation on a comparable measure to what we're seeing in Europe, of course, I'm always looking at this from a European lens. Inflation in the U.S. is actually lower than in Europe. And they are, one of the last, if not the last, major DM central bank to be cutting. So I felt that they should cut 25 basis points in July. Since then, the economy has softened. So perhaps it's not surprising that they've gone kind of all in for the 50 here now in September.
So, Katharine, what are they worried about? Are they worried? I mean, is this a cut into a possible recession that they're trying to make a slow, a soft landing, or are they just trying to prop up the labor market because they don't worry about inflation?
So my sense is that the recession outlook is a risk. It's not the base case. Clearly, as inflation has come closer to target, they have pivoted. They have a dual mandate to focusing more on the labor market. And I think what they're really trying to engineer here is basically a second leg of this soft landing to be able to, underpin that easing in the labor market to make sure it doesn't overshoot and tip into a recession, whilst keeping a gradual path for interest rates going forward to make sure that inflation remains contained.
So what happens next? The messaging from Powell seemed to be pretty clear, is that they're going to go gradually from here. There was a bit of market repricing. Where do we end up by the end of the year?
I mean, I thought that the Fed handled the comms really well. I think there was a risk that they could kind of spook markets by going 50. It could have a bit of a whiff of panic. But they really clearly messaged that from here on out, the cuts are gradual, and moreover, that they're going to end up at a higher level with that revision to the long-term DOD to really, hammer home that this is just a recalibration in the level. So I think what they are trying to engineer is a continuation of this soft landing. Yeah. And so I think as long as the data do not really materially deteriorate from here, then I would expect them to really follow this gradual path that they have signposted.
So, Katharine, when you look at some of what happens next in terms of treasuries, what are you interested in?
So I think although it's not a base case, I think the risks of a substantial weakening are there, and moreover that tips into inflation. So I think there is a growing risk, perhaps a little bit more in Europe than in the U.S., that we could see inflation undershooting the target, and that we get, not a return to the pre-pandemic decade, but, a bit more of a flavor of that. And so, I think the next big question is, do we really think that long-term endpoint is significantly higher than where it was before? Maybe the market is going to test that a little bit, and we see that come down further. But, that's all to play for.
So you're not, when you look at the worst case scenario, is that basically there's big fiscal, stimulus spending from whoever comes into the White House, and actually we're underestimating the stickiness of inflation in certain parts of the U.S.
On the fiscal, I think, my expectation is whatever the outcome of the election, that the impulse is probably going to be broadly neutral. Okay. I think it might be difficult to test whether there's appetite to actually increase fiscal from here. It's already pretty healthy slug of fiscal spending going in there. So to increase it further from here, I think would be hard. So my expectation, it's going to be broadly neutral. Mm-hmm. And so, I'm not expecting any kind of sort of strong reaction to kind of market concerns over fiscal. That's, again, a tail risk. But really, it's just about, has this long-term endpoint for neutral really gone up relative to the pre-pandemic period? I think that remains to be seen, and there could be some question marks around that, especially if the data keep coming in soft.
So, Katharine, what does a 50 basis point cut actually mean for the BOE today?
So I don't think it means very much for the BOE today. I mean, I could be proven to be wrong, but my guess is that they're still on track to, buck the trend and be on hold, so not follow the ECB or the Fed. But where I think it does matter is once we get to the early part of 2025. I think this does help enormously other central banks. It takes a lot of the kind of spillovers of this U.S. exceptionalism that was quite tough for the rest of the world, takes a bit of the heat off, and it does open the way for them to be able to more aggressively cut once we get into the early part of the new year. But just now, I think it's a bit too soon. Like the Fed, they're going to want to message that they're on a cautious cutting cycle for now.
Market pricing for Fed cuts and the BOE cuts seem to be off. The BOE has one mandate, the Fed has two. But actually, if you look at the strength of this economy and some of the concerns, would it warrant more cuts than priced in the markets?
I can see it looks strange. How is it possible that the ECB and the Bank of England are more cautious in terms of cutting when clearly their economies are significantly weaker than the U.S.? But I think we have to remember, first order, the inflation shock was different. In the U.S., it really was, a more kind of domestically generated boom because we had, very strong fiscal and we had very easy monetary policy. Whereas first order in Europe, including in the UK, the inflation shock was really because of events that were external. Right. So it's harder for European policymakers to control inflation. We just have to wait for this inflation shock to work its way through. It's on its final leg, we think, via services and wages. They just want to make sure that they've completely stamped it out. So it makes it look like they're a little bit behind the Fed, whereas in the U.S. we are seeing the cyclical weakness, inflation's coming down, so they can be more reactive. And, of course, then there's the mandate difference. But I think it's more that inflation shock itself was different in the two regions.
Yeah, and I guess the fiscal impact, the October budget could significantly change things. I know that Governor Bailey keeps on pushing back against that, but actually the economic landscape will change for the UK. What does it mean for your appetite for gilts?
I think, it looks to me like Chancellor Reeves is very much setting us up for what I call a swallow the frog a budget. She's going to front load the pain. Yep. And, that combined with the U.S., cutting now more aggressively, at least with its first cut, and then signaling further cuts, I think that is going to make it easier and pave the way once they get through this, wage setting round into early 2025, they can cut rates. And like the Fed, the UK is quite some way away from neutral. So once they are on that more confident path that inflation's coming down, I think they're going to cut quite aggressively. And, the end game here could be something that, doesn't look too dissimilar from the Fed, around 3%.
When you look at the world globally, what's your biggest unknown? Is it China and how China performs, or is it the price of oil that, frankly, has been quite helpful at the moment? It's almost like an extra stimulus for the world economy, but we don't know what happens next.
So I would say two things. One is, we've just gotten so used to the narrative about being high inflation. Do we really need to think and worry about deflation coming from China, the weakness in China, the weakness in energy prices? Again, those things are external, harder for policymakers at home to respond to. And I think the second thing is, this quantitative tightening, this balance sheet contraction, central banks stepping back from buying sovereign bonds happened during a time when rates were going up. So there were ready buyers. But are we going to see that if we see a continuation of QT with rates coming down and coming down quite sharply? Are we going to see a ready buyer? I mean, many people have kind of cried wolf on this point a long time. So, I don't want to overemphasize it, but we just haven't lived through that experience. So that's something for me that's like a bit of an open question for 25.
Katharine, as always, thank you so much for joining us. That was Katharine Neiss, Chief European Economist at PGIM Fixed Income. Now, coming up, car sales take a hit in Europe's biggest market. More on that and the EV demand story next. This is Bloomberg. Welcome back, everyone. Commerzbank looking to speed up the process to replace its chief executive, Manfred Knof. It comes as the German lender prepares also to respond to a surprise move by UniCredit, which this month disclosed that it built a 9% stake in Commerzbank and indicated it may seek talks. Now, let's bring in Stephen Ahrens, who leads Bloomberg's EU finance team in Frankfurt. Stephen, thank you for joining us. Who's in the running to be the new Commerzbank chief executive?
Hey, so definitely the CFO, Bettina Orlopp, who's also a frequent guest on Bloomberg TV. She is seen as a strong contender. She's the one internal candidate that's, I think, got a strong claim to the title. She was passed over, actually, for the role 4 years ago, we've reported. But we've also reported that they are looking for external candidates and have mandated a headhunter to help them with the process. So it could also be someone from the outside.
So how does this search for a new chief executive also play into the move by UniCredit?
Well, it's kind of a weird one. So Knof, the CEO, the current CEO, literally said he was not seeking a renewal of his current contract, which runs out at the end of next year. He said that one day, on the night, essentially, that this became public. And so that has added another layer of uncertainty for UniCredit how to respond to this, because with the CEO sort of saying he's going to be gone at some point, obviously that hasn't turned him into a lame duck yet, but it sort of raises the question, how soon will he be a lame duck? Can he lead the defense strategy that Commerzbank is working on? Can he lead the talks with Orgel, his counterpart at UniCredit? So I think it is sort of in the interest of many people to settle that uncertainty fairly soon and make sure they have a strong leadership in place to guide Commerzbank through a pretty, rough environment in the months ahead.
Steve, when you look at some of the things that's been said, how are actually the German press reporting on this? Are they worried that there's still UniCredit lurking? Have they asked Deutsche Bank to step in? What's the general zeitgeist on this?
It's an interesting one. So obviously the first reaction was shock. I mean, at least surprise, and in some corners also shock, because no one expected UniCredit to step in. As you probably know, the interest of UniCredit in Commerzbank has long been reported, including, of course, by us, for many years. But no one thought Orgel, the UniCredit CEO, would swoop in, would use the stake sale by Germany to swoop in and take a major stake in Commerzbank to sort of set up himself for a potential takeover at some point. So that's shock. Some people privately say, why not? If you look at the profitability of Commerzbank, it's much lower than UniCredit's. Orgel at UniCredit has done an outstanding job turning the bank around. It used to be a really weak one too, and now it's one of the strongest in Europe. So many people say if you can do it at UniCredit, maybe you can do it with Commerzbank too. So there's that too.
All right, Steve, thanks so much. Stephen Ahrens there in Frankfurt. Now, staying with Germany, and the country has led a drop in European car sales. Deliveries were dragged lower by electric vehicles, which plunged 69% in the year to August in the region's biggest car market. Now, joining us now for more is Bloomberg's Oliver Crook in Berlin. So, Ollie, more bad news from the auto sector.
Yeah, Francine, with demand squarely in focus in the auto sector, I'm sad to say you didn't get any good news from the August figures we got from the EU car deliveries. As you can see across the board, across Europe, sales were down 16.5%, led by which markets? The most important markets, by Germany, by France, down almost 30% in Germany, down 25% in France in the month of August, down 13% in Italy. This figure wipes out the year-on-year growth for the year-to-date from the auto sector within the Europe sales for both of these countries. It's still up a little bit across Europe, but if you switch up the board and take a look at how this has been faring in terms of the actual companies involved, you see that you have sort of Volkswagen sales down 13% in August, Stellantis down down almost 30%, BMW down 15%, Mercedes down 10%, and Tesla down 36% in the month of August. All of this coming as we've been reporting on some of the issues at BMW with some of the recalls. And of course, that sort of bombshell news that Volkswagen is thinking about closing factories within Europe. But Francine, it's not just in Europe. Volkswagen will also be closing some of its factories in China in its partnerships with SAIC, which is another sort of very poor omen in terms of global automotive demand.
So what more are we learning about the shift to EVs?
Well, listen, if you're wanting to find good news, it's not in the EV market. If you look at the numbers there, they're even worse than what we saw across the board. I mean, EV sales in the month of August, year on year, down 36% across Europe. If you look at Germany, down almost 70%. France, 33%. And in the 70% out of Germany, this has in part to do because some of these incentives that existed last year, so the comparable base effect of last year, August was very, very brutal. But as you can see, EV sales down 70% in Germany. The one bucking the trend, Francine, is the United Kingdom, up 11%. That's also mirrored by what we're seeing in terms of the year-to-date trend within the UK, which is also up 11%. If you look across all of the different categories here, you see petrol was down 18% in August, battery EVs down 36%. The big winner, Francine, it's the hybrids, the things that are sitting right between that transition between EVs and combustion engines, up 20% year to date. And of course, this has huge impacts in terms of kind of the questions about EVs going forward. There's a lot of people in the auto industry that say that there's a mismatch between what policymakers want and what the market wants right now. And also, if you look further down the value chain, this is also going to have an impact on the chip sector because all of those chips that they're supposed to put into those EVs, which take a lot more chips than other cars, with the demand coming down for EVs, that's going to hit the chip sector too.
Ollie, thanks so much. Oliver Crook there in Berlin with the very latest on some of these hybrid demands. Now, coming up, the yen slumps against the dollar after the Fed's jumbo rate cut. We'll discuss that next and what we should expect from the BOJ at their next meeting tomorrow. That's next, and this is Bloomberg.
Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year somewhere around 2 3/4 to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good.
Some of Bloomberg guests there on the Federal Reserve's first rate cut in 4 years. Now, joining us for more on central bank moves is Ven Rand from Bloomberg's MLIV team. Ven, thank you so much for joining us. What did you make of the cut? I mean, 50 basis points was bold, but actually the market was okay with it. So does it point to good communication or a blurriness about what happens next?
Well, I think that it comes down to good communication, because at the Jackson Hole address, Powell was extremely dovish, and we had those media leaks going into the meeting as well. So that set the markets up to expect a larger move. So which is why you didn't see a vehement reaction in the markets, albeit it was interesting that stocks could not hold their gains. So that speaks to a market that thinks that, look, the economy, we are well past the best buy date on the economy, on this economic cycle. So I think that the markets are a bit jittery, especially considering how much stocks have run up. I think that the 2-year Treasury yield has room to rise, because we had fallen 120 basis points so far this quarter. That kind of phenomenal rally hasn't been seen outside of periods where the economy hasn't been in great distress. So I think there is room for modest repricing here.
Ven, what do you think is most off? I don't know whether we get a curveball actually from the Bank of England today, because if you look at pricing for Fed expectations, the Bank of England, and you look at the respective economies, a lot of people just say it doesn't make that much sense.
Yeah, it doesn't make much sense at all. I think that the Bank of England has room and scope to go much faster on rate cuts. I think the room for them to cut rates is 250 basis points if you pass the Taylor rule. So there is plenty of room. There's no question about it. What makes today's decision interesting is the fact that we've got a new member on board, Alan Taylor, who's supposed to be more dovish than the previous Jonathan Haskell, who he's replaced. So I think that, you know, it's going to be a closer vote than the 7-2 split that the markets are expecting. And of course, Bailey has previously said that the markets are underpricing the risk of how fast the BOE can cut rates. So with those two caveats, we enter into this meeting. Let's see what it brings.
What do you think, then, is most interesting? I mean, there are a million questions that I have for you, but a limited amount of time. There's a BOJ, of course, tomorrow. I don't know whether the gravitational pull from the Fed changes anything there.
Well, I think that, you know, the fact that we've got an LDP election coming up by the end of this month is going to overshadow everything else that the BOJ does tomorrow. I would be extremely surprised if they hike. I don't think there are virtually no expectations that they will do anything of note. I think what will be key for the markets is whether they flag another hike in October or in December. I think that the markets are extremely complacent about when the BOJ will hike next. Not much is priced into the curve yet. But I think that the neutral rate in Japan is about 1%, and they will get to it because the economy is doing pretty well and inflation is ticking higher as well. Those wages are shaping up to be pretty firm. So I think there is very little incentive for the BOJ to just stand pat, albeit that's what they will do tomorrow.
Okay, Van, thank you so much. As always, Van Ram. I just got a note by Kit Jukes, which is very funny, saying there are disadvantages to putting a lawyer in charge of central bank, but one advantage is the ability to make a 50 basis point cut sound like a hawkish move. Now, coming up at 12:45 p.m. London time, we'll be speaking with the U.S. Transportation Secretary, Pete Buttigieg. That's on Bloomberg surveillance. Up next, Bloomberg Brief with Danny Berger in New York, and this is Bloomberg.